Hello, everybody, and welcome to the DATAcated Show. We have a special guest with us today who is a packt author. He wrote the book, Machine Learning for Algorithmic Trading. Can you guess who it is? Wait, I'll cover his face. Let's see if you can guess. He thinks the whole world knows him already. So let's see if you know who I'm going to be speaking with. Put his name in the comments. Really looking forward to this session. The person we have on the show is Stefan Jansen, and he was on the DATAcated Show probably about a year ago. I can look back and confirm, but excited to have him back. It was a really fun session before, and we have some new topics to talk about this time. But yet again, we are here to talk about machine learning for algorithmic trading. And before we bring on our special guest, I want to let you know that packt is kind enough to participate in another book giveaway. So if you'd like to play, all you have to do is put hashtag packt into the comments of LinkedIn, YouTube, Twitter, Facebook, or Twitch, wherever you're joining us from. And as always, we're going to do this fun automated raffle to see who the lucky winners are. We'll announce a winner about halfway through the show and then again towards the end of the show. So make sure you stay tuned. We are also taking questions from the live audience. So if you have any questions that you've been thinking about, in terms of algorithmic trading, let's see, machine learning, writing a book, anything that you want to know personally about Stefan Jansen. He has agreed to reveal it all on my show. I can see him smiling backstage. So yes, definitely make sure you ask us any questions and leave comments throughout the session as well to let us know you're here, let us know your thoughts. Without further ado, I'm going to bring on our guest speaker here. There you are.
Hey.
Hello, Stefan. Welcome to the show.
Thank you. Thanks for having me.
Absolutely excited to have you here. I'm just looking in to see who's joined us. We have a bunch of people saying packt, packt, packt. It's like they're chanting packt's name. I love it. I see Kimberly, lots of familiar faces in there. Thank you all for joining us. Really, really excited to have you all here with us today. Before we get into the topic, I know, Stefan, you were on the show before. But for those who might not know you, can you tell the audience a little bit about yourself?
Yeah. So my name is Stefan Jansen. I'm German originally, now again based in New York. I just returned. We spent a year in exile in Texas, in Austin, where I'd also been before. Currently, or for the last 5-6 years or so, I have a company that works with clients in different industries to help them introduce data science and machine learning into the organization. That's partly investing and trading and, partly all sorts of other stuff. And before that, I was a partner in an investment firm that was targeting consumer goods, long-term investments, and very data-driven. And I built the sort of data infrastructure and analytics, predictive analytics practice, right? With a few data scientists and new data sets and all this. And that was sort of in the relatively early days when data science was kind of starting to be taken serious in the investment industry. Before that, I was in fintech, and way before that, I worked in international development. So I've been around the world a little bit, but now I'm here in New York doing machine learning.
Great. Well, awesome. And very happy to have you back on our show here today. Let's see. We've got Ben joining us from Lone Star, Texas State. We've got people coming in from New Jersey. I'm in New Jersey now, so I've moved out of New York since we've last spoke. And it's so nice and quiet here. So, so the topic of the day, we're going to talk about machine learning for algorithmic trading. And I think it's always good to set the stage, right? So when I'm thinking of machine learning for algorithmic trading, what does that actually encompass?
Yeah, so we can sort of take it from the end, right? So there's trading, right, which, we know is sort of buying and selling of assets, typically on exchanges. That can also be elsewhere. Then there's this algorithmic part where, an algorithm is kind of a set of rules that a machine can sort of execute step by step to, take certain actions. So in this case, it would be buying and selling based on certain rules. And the interesting thing with machine learning is that now a machine learns the rules from data, and it's trained so that it sort of gets better and better in achieving some sort of performance measure, which, in the trading context, of course, would be your profit and loss, hopefully profit at the end of whatever period. So basically, that's what machine learning for trading would be about, or algorithmic trading, to develop a system that more or less automatically executes buy and sell orders to make profit based on some data. Now, that's kind of a very broad description, In practice, it can be many different things. It can sort of range from, I have a model that helps me predict returns, but there are still maybe manual rules that decide, maybe I'm just going to buy the top and bottom, whatever, 10% of the ranking that my model predicts, or I could have something that's way more sophisticated, like a reinforcement learning agent that literally learns the entire process from like, how much should I buy of each stock and when should I sell it, and that probably based on some model in the background that predicts return, but there are more decisions to take in the process, right? It's not just which stocks should I invest in, for instance, if it's equities, but it's also how big should the positions be and things like that, how should I mix the stocks, risk management and all these things, right? So you could think, and the large, very successful hedge funds, they're building systems that are more akin to something that is end-to-end automated.
Okay, basically, so what you're saying, the audience that have joined us today will learn how to make $1 billion by whatever you teach them here today. Is that right?
You just got to be faster than the next guy. So get on it right now. Get the book, read it, and by 11:30 it might already be a little late. So.
Oh, that's funny. Yeah, we've got people saying that they already found their next book to read. So awesome. People are going to pick up the book. I think it's always such an honor to meet the author of the book, right? And especially this book. I mean, you can even use it for working out. It is pretty massive. And I think let's spend a few minutes just talking about the book.
Yeah.
I know we talked about this a bit in our first show, but remind the audience, why did you write this? Sort of what was the thought process, and who's the book for?
Yeah. So one of the motivations to get involved in this was I've been teaching generally for quite some time, right? Economics earlier, and then data science for a few years at General Assembly, for instance, here in New York, or Data Camp and so forth. And I, especially while teaching at General Assembly here in New York, there were always quite a few people that actually worked in investments, folks from hedge funds or investment banks, etc. Right? And they were getting a fairly generic training in data science, right? Because of course there are these like generic things that you can teach, like, oh, I want to predict the color of the iris or cluster them and things like that. But then you have a whole different set of knowledge that really applies to financial data, right? Machine learning is all about data, so you want to know a little bit about the specificity of the domain-specific aspects of the data. And these courses never really touched on that, right? So I always was thinking at the time, these people, there's a different way of talking about machine learning in the context of trading that involves everything, like how do markets work, what do I have to know about financial data to actually use them properly, right? And also, how do I deal with the specific challenges in the context of financial markets, which, tend to be efficient, so very little signal in historical data, lots of noise. That's not always the same. If I try to recognize an object, an image, cats and dogs are not nearly as noisy, right, as price patterns in terms of where does the stock or whatever the asset is go tomorrow. So these are all very specific challenges that are really serious. They're not like, you can't deal with this with a little text box on the side, and say, well, actually everything we're teaching, it doesn't really apply, but, the general principles still hold. So that was kind of part of the motivation. And since I've been doing this before for a few years in the context of this investment firm, I thought it would be kind of nice to put some of this on paper. And the book reflects this a little bit in that in the second edition contains quite a bit of sort of intro into machine learning as well. So the assumption is that, well, you may know a little bit about machine learning, but it might be helpful to get the background on how models work and sort of a little bit of the theory behind this. It's not a theoretical book, I would say, but it does cover these things to some extent and references other sources, and then always demonstrates, well, now if you want to apply this to financial data, then here's an example how this would work. And it also goes very much into this end-to-end workflow, right? Because this kind of modeling kind of aspect of the workflow where you get your data and work with them and then predict something like returns. And then there's the actual trading aspect. And it's only really useful, or you can only really evaluate how good a model is if you understand how useful the predictions would have been had you actually traded on it. So that's where this whole backtesting aspect comes in, And so you can't really say, well, the correlation of the returns with the outcomes was X, so I'm going to make money. That isn't really telling you as much as, well, could I actually have traded those, right? So there are these practical aspects. So the book goes into this as well and tries to demonstrate how to think about this end to end and how to also work with this in practice,
Okay.
So
yeah, thank you for that explanation. I'm also wondering, since there's quite a bit of code in the book, do you think there's a prerequisite for the reader to have some programming language knowledge?
I mean, the book uses Python, and it would certainly help quite a bit and avoid some frustration if you already knew, for instance, how to work with pandas. If you basically literally wake up one day and all you've used before was, say, Excel, and now you read that maybe quant trading and automating things with Python is the future. Let's use this book to kind of deal with this all. It might be a little tough, right? It's asking a little much. So there are so many resources to kind of get started with these things. I would recommend doing this first. It's not that the code is like super complicated and it goes into like sophisticated software architecture and algorithmic optimization stuff. Not really. It basically uses libraries, right? So there's a lot of just calling libraries to execute things. But still, you want to be fluent enough that you don't get hung up on, oh, how do I actually write this code? What does that actually mean? And stuff like that,
Right. That makes sense. Okay, so I'm going to take a couple questions from the live audience here. First question from George Fierkin. He is asking, are there specific public machine learning algorithms used for trading, or are they all proprietary?
Well, so that actually goes very much to the heart of the matter here, right? So the book is written as sort of a toolbox, right, that uses algorithms, right? Say, I don't know, gradient boosting is an algorithm, right? It has been published and is known and has been implemented in code that is open source, right? That's the algorithm. Now, you want to use that algorithm, which you can also use to predict, I don't know, the success of a marketing campaign or what have you, right? Now you want to use this to predict returns. The proprietary aspect is, well, what are the input data? How do I use the input data to feed them into the model? What kind of returns am I actually predicting the next minute, the next hour, the next day, the next month, All of these kind of go into the ultimately proprietary setup of this end-to-end, if you want to call it end-to-end pipeline, of data selection, feature engineering, and then the actual model training in its specific form and so forth, right? And then later, of course, the actual trading strategy, right? Because even if two people that have the same model with the same prediction could take very different decisions on how they actually trade on this, go only long, go long short, different holding periods, etc., right? So there's so many different other parameters. All of these are proprietary, but the one thing that's public is the actual algorithm. At least as a starting point. You might even want to refine that, right? You could, of course, come up with your own gradient boosting variation, right? That's also possible, but that's maybe not the principal aspect here.
Okay, thank you. So I have an easy question for you, and then maybe a more difficult one. Let's start with the easy ones from Bharat. He's asking, does the book cover how we can apply some of these concepts to personal finance or personal investments?
I mean, the book is geared towards selecting individual assets for a limited holding period. So to trade maybe on a daily basis every 5 days, you can set it up to trade on a monthly basis. Some people do much longer holding periods, right? I mentioned earlier that, for instance, we were working in an investment company where the goal was really to hold consumer equities over months and even years. And there, actually, the goal of your prediction was not so much the return of the stock, but actually the prediction of how the markets would do. So the actual economies where certain companies were doing business, right? So how would consumers develop in different parts of the world, right? So you could, set up something like this for yourself. Now, of course, that is quite a bit of effort if all you do is invest, a certain amount of funds and don't want to be spending hours and hours managing these funds, right? So in theory, clearly it's applicable. In practice, you might find it a little labor intensive at some point for that purpose,
Yeah, makes sense. Okay, ready for the more difficult question? Well, I don't know. I think it'd be difficult. Let's see if you
Where
can.
does the market go tomorrow?
No. What has been your best trade or investment idea?
Yeah, good question. I mean, so there are many different aspects to this, right? And the only ones I could sort of mention was maybe in the context of this investment. So one thing is clearly to high level say what works best is ultimately data driven. So I work with clients that have access to some sort of proprietary data feed or a very proprietary way of utilizing data. And that is a very good starting point, right? Then on the other hand, there are simply, and this is actually kind of similar, if you get ultimately markets are efficient, right? So you need to get some insight that few people have and maybe get a perspective on that insight that differs from what other people think, So the other good investment ideas, I was always impressed especially like a few years ago when people were going deep into emerging markets and researching how these markets work and how companies were doing, because it takes some actual legwork, especially in the past, these were not as transparent. So you could do quite well. And also in a fairly interesting way if you actually like to kind of get around the world and do things like this. So some interesting pieces would come out of something like that. Of course, it would have been a great idea to buy Bitcoin 10 years ago.
You didn't? What do you
No,
mean?
which I did not, even though people were suggesting. But I was, of course, the good old economist dismissive. No, this is not a currency. This is not going to work. Well, it might still fail, but it's been doing quite well. So
Yes. Okay, so what will the market look like tomorrow?
It's going up. It's going down right now. So tomorrow it's going up, I think.
Okay.
Buy the dip.
Another question here. So what is the
No investment advice. No investment.
What are the day-to-day activities performed by algo trader, data scientists, and machine learning? And also, what are some future opportunities look like?
Yeah, I mean, the sort of the day-to-day activities have very much to do with the various elements of this sort of end-to-end workflow, right? Because if you start at some point, say you join a firm that actually uses machine learning to make investment decisions, right? In that context, there will already be some models in place. These models will make some predictions, and one or several models in combination will be used to at least influence the portfolio manager's decision process, right? There are not that many firms that do this completely automated. Very often there are portfolio managers that use or look at signals that models output, and then use that information to buy or sell. So once you're in that process, then of course you need to iterate all the time, right? Because on the one hand, you need to monitor whether the models continue to perform as well as they used to when you first developed them, and then you need to prepare for the signals that the models generate for these signals to ultimately decay. So that means you need to constantly be researching new ways of extracting value from data or looking at new data sets and things like this. So it's literally iterating over what you already have in place to keep it performing as well as it's supposed to. Future opportunities are really manifold, right? Because again, it's ultimately data driven. So utilizing more and more different data in smart ways is one key driver of opportunities, which also means, so for instance, natural language processing is clearly becoming more important. Some people would certainly argue that, there's quite a lot of information in text, right? What companies, so earnings calls, for instance, have gotten a lot of interest. That's still relatively recent. It's not like the newest thing on the block, but people have been starting to look at this with more sophisticated transformer models and so forth. So there's some interesting work to be done, but this is still relatively early stages, right? There's more sort of news flow and all these things that can be utilized. So that's like one area of opportunity, and just general, right? I mean, with the ongoing digitalization and so forth. Getting a little bit of sun here, right? Let's see if I can move around. With the ongoing digitalization, you simply will have more and more different data sources, and the advantage will come from being able to select and combine them in smart ways.
Yeah, I think it's going to be very interesting where we end up in the next few years, and I do want to cover that. Before we get to that question, I would love to do our very first giveaway. So I'm going to share my screen, remind everybody that it is #packt for you to play. And let me just show you again. This is the book you're playing for, Machine Learning for Algorithmic Trading, with that guy as the author, Stefan Jansen. Right, I'm going to go ahead and draw our very first winner. Good luck, everybody. You will have another chance towards the end of the show if you don't win now. And if you don't win towards the end of the show, you can always go to Amazon and get the book. All right, congratulations to Ariel Pai. I'll let you know how to get the book after the show, but you can also contact Tushar Gupta from Packt, and he will be able to get you the book. All right, moving on. Stefan, thank you. So far, I'm learning a lot, so thank you so much for being here. We do have a lot more questions that came in, but before we get to the audience,
I'm looking at them as well in the chat here.
Oh, you're looking. Is there anyone in specific you want to address next?
Well, there was one about programming languages, right? Python versus C and so forth.
Yes, I've been meaning to, from Ryan, right? This one?
Yeah, exactly. So, yeah, fair point, right? If you look at, again, sort of the workflow, right? A big question is, what is kind of your holding period, right? What is kind of the horizon at which you're trading? If you compete in high performance trading and light latency is everything, you will certainly not have a Python model running and trying to kind of process huge amount of data in nanosecond speed, right? So for this domain, clearly Python is not the right way, and you will have a ton of developers sitting there writing this in C++ in reality, or some related language. So clearly, now that is not everything that people do with trading, right? So many people and many institutions trade at longer horizons. Even if you do something at minute frequency already or 5 minute, it's pretty straightforward to get predictions out of a model to run Python. But even more importantly, the whole point of using Python is that this allows you to prototype, to develop models and see that they use, just as you do in so many other industries, right? I mean, there's so many other industries that require low latency inference, right? So you may find out also data science, because you want to iterate quickly, right? You don't want to have this super complicated code base where you sit and need 5 days to kind of get all the bugs out to actually get a prediction, but rather find something and see, okay, this is the architecture, this is the model that works, and we try this in Python. Let's now translate that and code this in C++, and that's an established workflow to put it in production, right? So even in the context of faster trading, it's not necessarily nonsensical to start developing things using Python, but there are limitations when it comes to building the actual infrastructure that runs in production. But that is the same as elsewhere, right? I doubt that Google is running its search engine or any things that run in the background there using scikit-learn, right? So
Right. Thank you. And then there's sort of another question that's related to models here from Kevin. He's asking, are the models only for equities, or can they be also used for other assets?
So in principle, so the book uses equities at different frequencies. So the bulk is, the book relies almost exclusively on free data in the second edition. That's actually, we'll talk about the third edition in a minute, but that's something I'll change in the third edition just because it's a somewhat limiting factor. So the book uses free equity data, mostly at daily frequency, but there's one data partner that offers minute data. So there's also examples at much higher frequency. But some examples use either international equities or ETFs as well, right? That's currently what's in the second edition, but that does not mean that the tools themselves are not applicable to futures or options, etc., right? Because it's about demonstrating a workflow and generating predictions, right? The features will be different, the input data will be different and so forth, but the overall logic will apply, right? And if you want to trade options or futures, you will need your own domain knowledge for that space anyway, right? So, which is a general point, right? The book does not give sort of ready recipes to kind of set up your little hedge funds or start making money tomorrow, but rather something that you can apply to a domain where you have specific expertise to pick data or set up a model that actually differs from what most people do.
Right. And Stefan, you mentioned the third edition. So a few questions there. I know you have a new version of the book coming out. When can we expect to see this updated version? And then sort of take us through what are some of the updates going to look like?
Yeah, so that's a little on the horizon. So sort of a specific date will be a little difficult. Hopefully, at some point this year, if things go really well, then maybe towards the third quarter. But it's not like my main job. But I will start collecting ideas, and there are quite a few items that are already on the list. One big change is that it would be great to actually use data that you would have to pay for, which means they're actually also higher quality. That doesn't mean that they're very expensive. So it looks like we have a partnership with NASDAQ for the third edition. NASDAQ acquired Quandl. So there's a ton of different data sets on their platform that cover fundamentals. So there's a lot of equity data, of course, right? Fundamentals and equity options and so forth. So there's a lot of interesting new pieces on that front. But then there's also fixed income, futures, Bitcoin, or cryptocurrencies, more broadly speaking, and so forth, right? So you should expect to see that diversity reflected in the examples, so which I think is great, because obviously that's what people actually do in real life. The price to pay is that, well, you cannot download all the data for free and just like run the thing. So you would have to, I try to sort of point out where you could potentially get free sort of lookalikes, to mimic that, but that will not always work, and it will not always be perfect, because obviously free data comes with, they may just be wrong. You don't know. So,
right. Yeah. Well, you
but
get
that's
what
one
you pay
aspect.
for, right? So it's
Yes,
free.
or what
You might not get what you need. Makes sense.
So that's one aspect. And just generally in terms of what's new is, so there's quite a few things that will be new besides the different asset classes. So the industry or the research has evolved a little bit in making models more finance specific. So there's quite an interesting strain of research. There was, I think, initially started by Brian Kelly, who's at Yale and AQR, that starts to build deep learning models. They're not very deep, they're relatively shallow, but the architecture reflects what researchers have traditionally used to model returns in sort of financial economics. So the idea that returns are driven by a certain number of factors, as opposed to using hundreds and thousands of variables. So there's like the original sort of kitchen sink approach, where you say, oh, I'm just going to take everything I have in terms of data and build a huge model and then hope that it predicts return, right? And then these more modern models, they say, let's distill out of these factors something that ultimately makes the model more data efficient, because it has fewer parameters, right? So there's some benefits to that. And they perform quite well. And it's interesting because it sort of marries now sort of what we have learned, because finance, of course, has a very long history in quantitative methods, right? It's not like they're just starting yesterday, which is one of the reasons why maybe they took a little longer to get off the ground than, say the consumer internet companies, right? Which were starting from scratch. So, but now that they're on it, they're starting to integrate what they've learned over the last 4, 5, 6 decades with sort of these new flexible models, such as neural networks. So that's kind of interesting. So there will be more. There's a little bit in the book already, right? So there will be more on that. Generally, I think the aspect of making the examples more sort of either closer to the research frontier or covering different aspects of what people in the industry do would be more pronounced, right? So there's that aspect. There are other areas, for instance, of what institutions do. For instance, so the second edition looks mostly at, let's just predict returns and then trade on that. There's, for instance, market making, right? So a lot of large institutions, they operate as market makers. So they provide liquidity, they buy and sell all at the same time. They may decide at which price to place a bid or an ask, and then for how long to hold it, etc. And the interesting reinforcement learning models emerging in that space, for instance, right? So that's interesting. So that will be covered. That's not necessarily so much for the individual hobby trader, but it does cover an important area where sort of the industry is adopting the technology in a more professional way, or more sort of it takes it on and then really develops it in a way that's suitable for the tasks at hand. Another aspect that's new is so at the very high end frequency, at the very high frequency end of the spectrum is tick data that's typically captured in order books, right? There's limit order books, where the exchange, say the NASDAQ, constantly records who is placing a limit order, right? Which means I'm ready to buy or sell the stock at a certain price, and then the order may just sit there. And that gives a lot of insight into what the liquidity in the market is, or the demand supply for a stock. It's very different from just seeing, well, the stock yesterday or just now traded for 150. when you know there's like, I don't know, millions of dollars that want to buy at different levels and much fewer that wants to sell, or vice versa, right? So it gives insight into the demand-supply dynamic. And then new interesting models coming out of Oxford, Man Institute. Man is like a large quant fund. They fund this institute at Oxford that applies, so one applies convolutional neural networks to the structure and the patterns that you observe in this limit order book. So that's kind of interesting because that's like fairly cutting edge and highlights another area in which the industry is evolving. Again, at the high frequency end of the spectrum, very data intensive, and you need a ton of infrastructure to actually do that. But, I think it's a fair point to sort of show that as well, to make it more diverse.
Yes, Stefan, a follow-up question on the limit orders. Is that data available for people to actually see? Like if I'm trading a stock, let's say Apple, and I have a limit buy order, I guess when I was trading stock, I always thought that was only for my eyes only. Can other people see that?
Not that this is Kate that now wants to do that necessarily, but if the order appears in the order book, depending on the access that you have, folks can certainly view that if they pay for this, right? Because it's registered in the exchange, and so that's one piece, right? When you trade on Robinhood, and then the order gets shipped off to Citadel, so other people also implicitly see what you're doing, which may or may not be to your advantage. But the order book literally works like that, right? People sort of play games with this, right? You place orders, you withdraw them because you sort of want to maybe fool other parties in terms of what you're intending to do or what the market looks like at a current play. So it's a competitive environment, right? So it's like playing games, and maybe it's good if you place a bunch of orders that you're potentially willing to buy stuff at a high price, and then everybody gets really interested in buying this because they think, but then you start selling because then the price goes up, so whatever, so there's a bunch of, and this is kind of how it's sort of more sophisticated, at the larger shops, how this kind of would work.
Very interesting. Thank you. We have a question here from Amit. He's asking if these algorithms are hard-coded for the US exchange, or can they use for other exchanges as well?
No, not at all. I mean, so there's one, some of the limitations, again, are the use of free data, right? So the book originally built a little bit on the tools that Quantopian had developed. Quantopian is this, used to be a crowdsourced hedge fund, fairly generously funded by Google Ventures and others, that eventually wasn't successful, and the team was sort of acqui-hired by Robinhood. So they also they used a lot of a data set that had been developed by the community and hosted by Quandl, which was now acquired by NASDAQ, and that is US equities. So quite a few examples rely on that data set simply because everybody can get it and it's free. Nothing stops you from, substituting in your what have you, right? Bombay Stock Exchange or China or something in Europe,
Yeah. Okay.
That's the whole point, right? The whole point of the book is to show this is the overall framework. Please bring your own data, otherwise it's not that useful anyway.
Yeah, makes sense. All right. Question from Pamek. How exciting, and this is for you personally, how exciting is algo trading for you? And he's asking for some pros and cons. Maybe just give us like your favorite part, your least favorite part of the space.
So I think you have to be clear, it's actually very hard, right? So it's very competitive, and some people sort of jump in sort of starry-eyed that, machine learning, it's just going to be a piece of cake, So it's not, because you're not the first to think that, It's just like so many other things in investment. There are the 80s and the 90s and the 2000s where certain things that look like extremely simple from today that worked really well and made you a lot of money. So that's kind of the starting point. Now, of course, then on the positive side it is very challenging because you get rewarded directly for your efforts, right? You don't have that many places where sort of your decision and your own intelligence ultimately in coming up with a unique solution is directly related to your payoff at the end of the day. That doesn't happen that often. That's why people are attracted to it, right? Because they literally want to outsmart the market, and directly if you look at your P&L if that was working or not. And surprise, surprise, sometimes it does, and sometimes it does not. So if you're attracted to kind of a setting like that, then this is certainly very good. If you rather attracted to a steady job, yeah, maybe where
stick
you
with
always know what happens the next day, and you kind of want to take it easy, then there are many better places to achieve that.
Makes sense. Absolutely understand. Okay, question here from Daniel. Do you take external non-market specific data into account in your models?
So the book kind of divides it into market fundamental and alternative data. So if you say non-market specific data, you're probably referring to alternative data, I'm assuming, right? So market data is everything that sort of the exchanges generate, like the pricing and the volumes and so forth, which often goes into this technical analysis kind of part, right? The charts and all the different indicators that use these inputs. Fundamentals is what companies report, earnings, revenues, costs, and so forth. So alternative data is literally everything, and there's a chapter on alternative data, and there are several examples, especially in the natural language processing part. Naturally, right? I mean, we use earnings calls, we use SEC filings, and then some non-financial data to illustrate certain techniques that are less interesting. There, of course, the challenge is there are not that many, and I think there's a news data set actually. So I think I've used some Reuters news or something. So there are examples that utilize these data sets. Again, on the free data side, it's somewhat challenging to have large-scale, super interesting data that are just available for free. So that's kind of. But again, like once you know the general technique, you can apply this elsewhere. We use images. There's a little bit on images. Images are kind of hard. There's always this idea, I can use satellite images to predict how many people are visiting the shopping mall, or where the tankers are going, and what the harvest is going to be like if I trade commodities. And there's some validity to that. The reality is that very often you might actually get better data that tells you that is much closer to the source if you really want to learn these things ahead of time. So it's much better to get actual credit card company data to understand what people are actually buying at the mall than counting sort of the cars on the parking lot, because who knows where they're actually going. Maybe some people are just sleeping in their cars, or there's an event nearby, and maybe they all just go to the food court. Or so there's kind of it's less direct. And sort of more noisy ultimately, right? Same with tankers. I mean, if you get access to the actual logbooks at harbors, right, at the stations that sort of process the cargo, that's of course much closer to the source than see some tankers floating around in the air, So
right.
So there are examples like that, but I think text itself probably is more interesting than many images. But there will be exceptions, right? So.
Yeah, very interesting. I never actually thought about the use of images in this, so very, very interesting. But like you said, it might end up confusing you even more, right, by giving you maybe misleading information.
I think it was like one of those things that early on were sort of very prominent in the debate. We got all these insights from satellites. Everything is now crystal clear. And I think that may certainly exist, but you have to really know why you're using the images and not some other source of data that might give you a similar insight of higher quality, So
because images are cool. That's why they're new, they're interesting, and you want to
and that also was what was driving the success of deep learning initially, right? I mean, 2013, AlexNet and all this stuff was all based on images. So clearly, that had kind of the aura of, the real new stuff. So.
Right. All right. More questions. One from Tyrell. So you mentioned that you need first movers advantage when it comes to models being used in production. What is the average time frame for projects at hedge funds that you've worked with? And what is the project workflow like when introducing new ideas into the pipeline and seeing it through to the end? I don't think there's like a general average time frame, right? I mean, it really depends on the specific setting, right? I mean, things work different in a high frequency environment than for people that have months of holding
periods, right? So large institutions, say pension funds or so, they will not be trading every other minute, right? It would probably not be worthwhile given the transaction costs, So they still might want to use predictions, So there the cycles would be much longer, right? And since the cycles are much longer, so you buy something, you hold it for a month, and you really evaluate it maybe about after 2-3 months. You will also not be sort of renewing the models that much, right? So that's kind of one end of the spectrum, And at the other end of the spectrum are things that happen every day, where you have sort of a profit and loss, so almost every second, right? So clearly in that environment, you will notice much sooner if a model, for instance, is not performing as good as baseline, over some period. So clearly you'll be iterating much faster there, So it really depends very much on the context, that you're in.
Okay. Yep. Thank you for that. Kevin wants to know your favorite financial news source, if you have a favorite.
I mean, but Bloomberg clearly is kind of still a very prominent name in the game. Just look at the number of journalists they have. If what you want is sort of fast news that covers a bunch of different areas that are related to trading, I mean, that's why people pay whatever, 25, 30K for the terminal, right? A significant chunk of that is the news you get there.
Right.
So, but then of course there's a bunch of other things that are more deeper, longer term, right? And there are people that write specific newsletters or that write. I mean, some of the financial press is also not that. I mean, I read Financial Times very regularly, sometimes Wall Street Journal. So so this is more like looking, I don't know, like a deeper report, looking at a specific issue, things like that. So it really depends on what you want to get out of it. Books are also not bad, right? So that's not news, strictly speaking, but it may be news in the sense that it introduces a new technique or a new, a new aspect that's also used. So it's a little bit of sort of news, technologically speaking, maybe.
Right. So let's talk a little bit about the future before we get to our wrap up and final giveaway here. I know you mentioned a little bit about natural language processing and sort of that being used in algorithms now, and we talked about images. But what else do you expect to see in the algorithmic trading space?
Yeah, I think generally the process that you're seeing right now, that different sort of areas or aspects of the general workflow as an institution like a hedge fund or some buy-side investment house, that be that risk management, be that portfolio construction, right, or be that stock selection, all these different steps in the process that right now different people might have their hands on, they all will be incorporating some sort of data science, machine learning, right? And the mix between the human and the machine will vary depending on how complex these things are, as everywhere else, right?
Yeah.
I mean, it's not like the doctors are going away, but the doctors are using maybe more insights generated from images. The same for a fundamental analyst that looks at companies longer term, might also be quite happy to actually get decent machine learning model forecasts of the revenues or so of that company. That's helpful, right? It's maybe better than just doing a sort of straight line projection or plugging in some growth numbers into an Excel sheet. So you have you have that, but then of course you will also have more institutions that sort of will try to set up this end-to-end automated workflow. I think that's not that's far from an off-the-shelf solutions. I think it's early days to do this, and probably some scale is required, and some have closed shop, right, or have kind of aborted these attempts. So I think the jury is out if we will have very soon a large number of fully end-to-end automated sort of like reinforcement learning bots dominating the market. That doesn't mean that in certain areas that won't be successful, but at scale and across the board, we'll see. In 30 years, that will be a very different story, So
in 30 years, I know. Oh my God, I finished reading the book 2041, AI 2041. Not sure if you read it or heard of it. It's by Kai-Fu Lee and Chen Chu-Fan. It's basically 10 predictions for the next 20 years. Very, very interesting. If you're into that sort of thing, it's kind of like a realistic science fiction with this AI expert who sort of predicts what could happen.
Yeah.
Oh my goodness.
What are your top three? What are your top three predictions from that? Do you remember?
Okay, so the one that really stood out for me was the displacement of workers, right? The people whose jobs are sort of being automated, and how we're going to have to work with robots. That one was very, very realistic for me because I could see this happening, with autonomous driving and all that. The second one, there was basically giving up your data for better insurance premiums. That was another interesting one where they basically follow you around. It's pretty much what we have with our phones now, but on a larger scale where they actually use all that data to determine what sort of premiums you need to get.
Yeah.
And then
they try that with cars a little bit already, right? I mean, you can plug these devices into cars, so you get a little bit of that. I don't know if that really is.
Yes.
But it's going, it started.
Yes. I mean, and then there was some really depressing things like, warfare and all that. That was just very eye-opening of how it depends on which way the world's going to go, right? With AI, it could be really, really good or really, really bad.
Yes.
Hopefully we'll be somewhere in the middle, like we usually are in this world. But very, very interesting book. That's going to be our book of the month for February. We have a data book club that we manage. So
interesting. Yeah, these are really relevant topics. There was one interesting thing I came about like a year ago. So the question was general artificial intelligence, right? Is this going to happen like anytime soon? And it was a survey of all the folks that were participating in the large machine learning conferences, right? So academics at the research frontier. Yeah. And one thing that was so striking was that most people were like, yeah, it might happen, not anytime soon, maybe 2070 or something like that. There was one group of researchers that was much more aggressive as to when that would happen. Do you have a guess what group that might be? And whether it would be age or geography or any other factor that might distinguish them?
I don't know. Were they Germans? I don't know where you were.
No. The Germans are so skeptical. The Germans are like, nah, we probably don't really need this. We already have like good mechanical engineering, which works quite well, No, it's the Chinese.
Okay. I was going to say Russia or China next. So
yeah, they were literally way ahead of everybody else in their expectations, And so that's really interesting. Your fast moving environment shapes your expectations probably to some extent. And of course, in China, certain things work better, right? If you need access to data, maybe certain places get a head start over their Western competition.
Yeah. And then, so Kai-Fu Lee wrote another book about AI superpowers, and he talks a lot about
I know
China
that,
in that book as well. So lots of interesting stuff. All right, everybody ready for our giveaway? Let's see. I'm going to add this to the screen again. So congratulations again to Oriol. We're going to draw this in just a second. Before I hit draw, just a question, Stefan. Where can people get your book if they don't win right now?
Well, there's Packt has an online store, right? There's certainly Amazon, and so there's the electronic versions, and there are hard copy versions. I heard from so it depends on your reading preferences, and of course there are these online subscriptions, right? There's Safari online and O'Reilly and these things, So there are a few different sources. Also, if you're just interested in the topic, then and you like code, then I'd really recommend to check out the GitHub repository because there's literally like 150 different notebooks out there you can just look at. So you either Google like the name of the book and my name, and then on GitHub you find it, or you go to ml4trading.io where you have a bunch of information about the book, including all these links and so forth.
Okay, perfect. Yeah, guys, check out the GitHub. And Christine said she's got the book. The hard copy is going to arrive tomorrow. So
cool.
Okay, awesome.
Thank
you.
Right.
So.
And there's also on this ML4Trading website, there's actually an online community. I think it's exchange.ml4trading.io. You can ask questions about the book, and people hopefully will respond, or I will respond. So there's a little bit of a community growing that hopefully we can push a little more with the next edition if you get there.
Okay, sounds good. All right, I'm going to go ahead and draw. We're going to pick two more winners. So we got the first one down. Let's see, our second winner. Congratulations, everybody who played. All right, Sammy, we will follow up with you as well, or you can reach out to Tushar Gupta from Packt, and he's going to provide you the book. I love watching the little glitter setup. Gonna go ahead and draw one more time here. Thank you, everybody, for participating. I always love this. It's so much fun for me to watch it. slow down. Congratulations, Quena. We are going to follow up with you as well. And Stefan, I want to thank you for imparting our knowledge on us, your knowledge on us once again here. It's always great to have you on the DATAcated Show, and huge thank you to Packt for this fun giveaway that you sponsored. Stefan, if people do have more questions, where is the best place to contact you?
Yeah, so if it's code specific, then use the GitHub repo. There's an issue corner, we can ask questions. And then there's this community that I mentioned, exchange.ml for trading, with the number 4 in the middle.io, where you can ask more general questions about the material, your understanding of the book, etc. You'll see there what kind of questions people ask.
Okay, awesome. And I'm guessing you're also on LinkedIn.
Yeah, I'm on LinkedIn, right? I'm on Twitter, also on the ML for trading, and starting to be more active there, but have been posting more on LinkedIn then. Anyway.
Okay, well, everybody, thank you so much for joining. Follow Stefan Jansen on LinkedIn, follow Packt on LinkedIn. They're doing great work. Thank you again, Stefan, for being on the show, and thank you everybody for joining.
Yeah, thank you so much for having me again. I had fun, and who knows, next year, 3 times a charm.
Yeah, we'll see you after the third edition is out, Stefan.
All right.
Awesome.